Can understanding debt history prevent future economic bubbles for teens? Imagine a world where everyone knows how borrowing money works and how it can cause big problems. Sounds pretty powerful, right? That's what understanding debt history is all about. When teens learn how past financial mistakes happened, they can help stop similar issues from happening again in the future. Debt is borrowing money that you promise to pay back later, often with extra money called interest. There are many types of debt like student loans, credit card debt, mortgages for buying houses, and even loans companies take to grow their businesses. When too much debt is taken on, especially if it's risky or unmanageable, it can lead to economic bubbles. An economic bubble is when the price of something like houses or stocks gets way higher than its real value. People want to buy it because they think prices will keep rising. But when everyone tries to sell at once, prices drop fast and many lose money. This can cause a big economic problem called a financial crisis. Debt plays a role in these bubbles because borrowing money makes it easier for more people to buy assets. For example, if banks lend too much for houses, it can create a housing bubble. When people can't pay back their loans, the bubble bursts, and the economy can suffer a lot. Looking at past bubbles shows us that they often happen when borrowing grows too fast and lenders don't check if people can really pay back. The housing bubble before the year 2000, a financial crisis, was caused by risky mortgage loans. When the bubble burst, it led to a deep recession that affected millions. For teens, understanding this history is important because it shows how irresponsible borrowing and lending can cause big economic problems. If teens know about past mistakes, they can avoid taking on too much personal debt, like credit cards or student loans they can't afford. They also learn how government and company debts impact the overall economy. Some practical lessons for teens include not borrowing more money than they can pay back, understanding how interest makes loans more expensive, and being cautious about investing in things that seem too popular or expensive without real value. They should also remember that economies go through ups and downs, and bubbles are part of those cycles. Knowing about debt history helps everyone make smarter choices. When more people understand how risky borrowing can lead to bubbles, they can support policies that promote responsible lending and borrowing. This can help prevent bubbles from growing too large and causing economic trouble. In short, understanding debt history gives teens the tools to recognize risky financial behaviors and avoid repeating past mistakes. It connects managing personal debt wisely with how the economy works on a bigger scale. This knowledge can help keep the economy stable and protect future generations from financial crises.